Okay, welcome back. This is Principles of Accounting 1. I'm your host, Dr. B. Today we're going to be going over Chapter 3. Here in the class, I do want to have a few quick housekeeping announcements. Some of you are still having issues accessing the textbook, which I totally understand. I know that the bookstore is a bit of a mess. They're having some issues with their new program that they rolled out with. So what I recommend that you do, if you have not done so already and you're still having access issues for the textbook, is that you please contact the bookstore manager. And I can provide you with his email address at the end of this session. The bookstore manager seems to be the one responding most to students. So if you are still having issues accessing the textbook, the bookstore manager is going to be your person of contact. Okay, so that's the book. Now, course content. Some of you still have not yet completed the orientation module. This is a bit of a problem because we're already in the third week, which means you have not yet completed the Chapter 1 quiz, and some of you have not completed the discussion board for Chapter 2. So, okay, so here's what you need to do. Select course content, and the first thing you should see is this orientation. Select orientation. It opens up. The first thing you should see is this course readiness survey. Looks just like this. Okay, on your screen, it looks just like this. To complete the course readiness survey, select this Click to Launch button. Click to launch. It shows up like this. Then select Begin and answer all 6 questions. Once you answer all 6 questions, select Save and Submit at the bottom right corner. Then click OK. Click OK again. Click OK again. And it brings you right back here. Once that's done, if you select back to course content, the rest of the modules will now show up. We need to make sure that we complete all of Module 1 by the end of this week. Oh, I'm sorry, most of Module 1, right? Where are we? We're in week 3. So up until week 3 by the end of this week. So what does that mean? The first thing you should see is the textbook chapters 1 and 2 that your colleague was so we're very thankful to your colleague to be able to provide this to us. For those of you who did not yet have the textbook, that was very nice. If you keep selecting this next page button, it'll bring you down to it'll have you read the objectives, weekly assignments. It brings you into the learning materials. The PowerPoint presentations are attached here. Keep selecting that next button, that next page. A couple of videos are embedded. When you get down to learning activities, on page 12 of 50, within that learning activities folder, you should see this Chapter 1 quiz. Select Click to Launch. Select Continue. And answer the questions in the quiz. And you'll keep that going through that same process for every week. Just keep going next, 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 to be able to access the quiz and the homework. Are there any questions in regard to that process? We're good? Okay.
Yes.
Great, thank you. So again, some of you still have not completed that very first orientation module. That needs to be done immediately. Then you need to make sure that you complete weeks 1 and 2 and then get to where we are currently with week 3. That should all be done by the end of this week. Because here's the problem. There's only 16 weeks in this course. Well, technically it's more like 14, right? So the reality is the further you fall behind in this course, the more difficult it is to catch up, and the chances are you will not pass if you fall further behind. So please, 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 make sure that you complete all your quizzes, homework assignments, discussion boards, all that good stuff. Very, very important. Okay, I'll get off my soapbox. I apologize. I went on a bit of a tangent, but I just want to make sure that all of you are up to speed, because I don't want any of you to fail. I feel so terrible when that happens. But I will say this. The only reason you would ever fail this course is because you didn't do the work. That's the only reason you would fail. Okay? So do the work and you'll pass. It's really that simple, honestly. Even if it's not 100% accurate, it's okay. The idea is to get you through the course, right? So please, try the work. Very important. Okay, I apologize on that slight tangent. I just needed to get that out of the way because it's very, I'm very passionate about helping all of you, okay? And so I want to make sure that you pass this course. It's very, very important to me, and it's important to you. Okay. That is the course content. So let's pop into Chapter 3, which is where we are today. So if you go to Module 1, come down to Week 3, which I guess you really do have to keep clicking Next, right? So if you keep clicking Next all the way down to Week 3, and you can get down to this Chapter 3 PowerPoint. I'll see if there's a quicker way to fix that. I don't know. I'll figure it out. So get down to Week 3. And we are in Chapter 3. The Chapter 3 PowerPoint looks just like this. Okay, so let's talk about Chapter 3. This is the adjusting process. Throughout the first 2 chapters, we covered the majority of the accounting cycle. In the first chapter, I believe we went through the understanding of the chart of accounts. Chapter 2 was had a lot about the journal entries. Chapter 3 is the adjusting process. With the adjusting process, we are looking at making adjusting entries based off of what has happened in the accounting cycle. So let's go ahead and start from the beginning, and we'll go through. When you have questions, please feel free to unmute yourself and ask your question. That's the best way to do it. And then, of course, I'll give you some examples along the way to help things more relatable, more understandable that way. Okay. So, you learned a little bit about the difference between the cash basis of accounting and the accrual basis of accounting. As you know, in the cash base of accounting, we recognize expenses and revenue at the time the cash is received. In the accrual base of accounting, we recognize revenue and expenses at the time that they're earned, not necessarily when we receive the cash. When we receive the cash, that makes no difference. The difference for accrual basis is we recognize the revenue when we earn the revenue. What does that mean? If I sell a product to you, if I sell a coffee mug to you, okay, I sell you this coffee mug, and I sell it to you in the month of September, and I say, hey, you have 30 days to pay me for that coffee mug. Okay, great. So 30 days from now, as you know, it'll be in October. But I'm going to recognize the sale in September because I made the sale in September. I earned the sale in September. Okay? I didn't receive the cash until October, but I made the sale in September. I delivered the product to the customer in September. So therefore, I recognize the revenue at the time of the sale. That's the primary difference between accrual-based accounting and cash-based accounting. The same can be said with expenses. For example, I recently received my water bill from WSSC. The water bill, it covers the past 2 months. of water consumption. So what I do is I enter the water bill for those 2 months. So I would enter the water bill, I would actually make an adjusting entry, and I would enter that water bill in for the month of August because I consumed that water in August. Okay? I may have just gotten the bill, but I consumed that water already in August. The same with electric. You get billed after the fact for utilities, right? So therefore, we recognize the expenses in the month that they occur, not when it's paid. We recognize the expenses in the month it's incurred, not when it's paid. That's the difference between accrual-based accounting and cash-based accounting. The generally accepted accounting principles require the accrual base of accounting. Now, here's the thing. Most businesses use cash-based accounting. The reason being is because those businesses are small. And it's easier to use. However, but when they file their taxes, they need to convert it to the accrual-based system because it's recognized by the generally accepted accounting principles. Let's talk a little bit more about the cash-based accounting. With cash-based accounting, we recognize the revenue and expenses at the time the cash is received or paid. And again, most individuals and businesses utilize this because it's easier to use. However, the cash-based accounting system does not provide an accurate picture for financial statements. What do I mean by this? Well, in the accrual-based accounting system, we recognize the expenses and the revenue at when we incur or when we earn it, right? It's more accurate to recognize expenses and revenues when it occurs, not necessarily when you're receiving cash. When you're receiving cash, it doesn't accurately reflect the true expenses of the business. This is chapter 3, right? Yeah, of course. Feels like it's earlier than that. Okay. I know some of this is kind of repetitive because we did cover some of this in chapters 2 and 1, but it's the bit when we discuss principles of accounting, we're really discussing the foundations, right? And so you'll recognize that a lot of these are interconnected. With respect to revenue and expense recognition, we follow the revenue recognition principle that says revenues are recorded when services have been performed or when products have been delivered to the customer. Going back to my earlier example, if I sell you a coffee mug this month and you don't pay me until next month, I'm still going to recognize the revenue for this month, right? Because that's when I've delivered the coffee mug to you. Revenue is normally measured as the assets received, such as cash or accounts receivable. The process of recognizing revenue is called revenue recognition. Let's talk about the expense side. Under the expense recognition principle, the expenses incurred in generating revenue must be reported at the same time the period is related to revenue. In other words, if I receive an electric bill and the electric bill covers what happened last month, then I want to make sure that I enter that bill into my accounting system for last month. I'll predate it back to August. The reason being is because we need to recognize the expense when the expense actually happened. We call this the matching principle. Yes, Keandre?
So I had two questions. Just answering that question, that like statement you made.
Mhm.
Would you wouldn't need to do that if you accrued for it, correct?
You would not need to do it if that's correct. Yep. Basically, it is the accrual process. So if you
Oh,
have an
okay.
accounting system like QuickBooks and you are entering the bill in, you enter when the expense happened, right? And
Yeah.
so in that process, we are accruing it. Basically, all accrual means is that we've received a bill for something that's already happened, but we have not yet paid that bill. And so therefore, through the accrual process, we are indeed recognizing the expense and the revenue at the time that they've actually happened.
Okay. And then last question. I think you kind of covered this, but if you can go a little bit more in depth, why would the cash basis of accounting be less accurate than accrual base if the cash if the revenue is going in and out on like in that same month rather than accrual, you're accounting for it, but the revenue streams haven't actually, like gone through.
Right. Yeah, I hear exactly what you're saying, and that's a great question. So here's the reason why accrual is a little bit more accurate than cash. So let's think of it this way. So going back to my coffee mug example, let's say I sold this coffee mug to you at a retail store. You come in and you pay cash for it. Uh, I would recognize that sale in September. Okay. If I sold it to you and and I didn't receive the cash from you until October, it actually makes October's revenue look higher than what it actually is. Does that
Okay.
make sense?
Yeah.
Yep. And that's the reason. Because if you look at your financial reports, you look at your income statement every single month, you're going to say, okay, well, I know I sold that mug in September, but in October, I see a higher revenue amount. It's because when you're using the cash process, you're recognizing that revenue in October instead of when the sale actually happened.
Okay.
Does that make more sense?
Yeah. Yes.
Awesome. Great. Yeah, good question. Thank you. Okay, so let's talk a little bit more about the expense recognition principle. This is also called the matching principle. The matching principle is by which I match my revenues and my expenses during the period that they actually happened. Okay, which and all of this it falls in line with the accrual process. The adjusting now here's the thing. When I get my electric bill, like I got a few days ago, it was for the month of August. Okay, so I need to then make an adjusting entry in order to properly match that expense with the month of August, because that's when the month of because the bill was to represent the electric that I consumed in the month of August. So if I get that bill in the middle of September, I need to make an adjusting entry uh, into my accounting system to reflect the consumption of the electric for the month of August. That's the concept of the matching principle. Okay, so let's talk a little bit more about that adjusting process. I just gave you an example of receiving an electric bill in the middle of September, but the electric was actually consumed in the month of August. So how do I then make that adjustment? So let's talk about the adjusting process. At the end of an accounting period, and again, an accounting period, as you know, it could be a month, it could be a quarter, it could be half a year, or a full year. I typically, when I am making adjusting entries, I typically do that on a monthly basis. And the reason why I do it monthly is because I want to know exactly where my business is at any given time. So instead of waiting to the end of the year to make these adjusting entries, I make the adjusting entries every month. Now, and that's pretty typical for small business. But if you're running medium or a large size business, you might wait until the end of the year to make your adjusting entries. But regardless of when it is, at the end of that accounting period, the unadjusted trial balance is prepared to verify that the total debit balances equal the total credit balances. Now, as you've learned in the first two chapters, when you are making entries into your ledger, every transaction affects two different accounts. Okay, and with every transaction, you have a debit entry and a credit entry. For example, if I am selling this mug on account, I would make the following entry. I would debit my accounts receivable to increase the accounts receivable, and I would credit my sales account. Okay? So again, debit and credit. The amount that I enter into that transaction is going to be the same exact amount for both the debit and the credit. The accounting equation must always be in balance. So your debits and credits must always equal. Many of these account balances are reported in the financial statements without change. Now let's talk about the rest of the adjusting process. Some of the accounts on the adjusted trial balance require adjustments for the following reasons. It could be sometimes expenses are not recorded daily. That's one reason. Some revenues and expenses are incurred as time passes rather than separate transactions. An example, the example that your book gives is rent received in advance expires and becomes revenue with the passage of time. Example, okay. Let's say you run, you have an apartment building, okay, and you rent out apartments to tenants, and the tenants pay you rent every month for that month. A tenant might pay you a month in advance, okay. For example, on the 21st of every single month, I pay my landlord for the rent for the following month. The landlord on her books, it will be recognized as unearned rent. The reason why it's unearned is because the rent that she collected this month is for next month. Next month hasn't happened yet. But on the 1st of next month, she can then make an adjusting entry to turn that into earned rent. Or earned rent, which, as you know, is a part of your revenue. And the same could be said with insurance. Many of us, we prepay our insurance for the 6 months, or a year. When we prepay our insurance, it's an asset to us, and it's a liability to the insurance company. It becomes an expense to us when that insurance is in effect. And it becomes revenue for the insurance company when it's in effect. And then, of course, another reason is some revenues and expenses may be unrecorded at the end of the accounting period. An example is a company may have been provided services to customers that have not yet been billed or recorded at the end of the accounting period. An example would be, let's say I have a lawn service, okay, and I mow your lawn. So I provided the service, but I haven't billed you yet for that service. I mowed your lawn, and then after I mowed your lawn, then I sent you a bill in the mail. And so I will have to make an adjusting entry at the end of the accounting period to reflect that I provided the service, but I haven't billed the customer yet. So I would enter that bill in as an adjusting entry.
I have a question.
Go ahead, Kendra.
Since I work in hospitality, and I think you said you had experience as well, does it typically work like in hotels like we do like events and stuff like that? And typically,
Absolutely.
you have two options where you can prepay, or you do the event and then we send you a bill after. Is that kind of the concept of like
Yes,
billing after the event?
100% correct. That's right. So that's if you send the bill after the event. So in your example, Kendra, the same would apply for unearned revenue. So for example, let's say you work at a hotel. Your hotel provides wedding services where the wedding party rents the space for the wedding, right? Which is very common, as you know. So what we would do, what the hotel would do, is we typically take a deposit, right, for
Okay.
that wedding venue, and that deposit is unearned revenue for the hotel. We record it as unearned revenue. It becomes earned revenue when the wedding actually takes place, and so we would need to make an adjusting entry for that wedding, right, in order to recognize the revenue that we have then earned. So we'll go from unearned revenue to earned revenue. So yeah, that's one example, and then as you said, Keandre, a second part to that example is that after the wedding takes place, we might then send a bill thereafter to recognize other expenses that have incurred after the fact, right? And
Okay.
so then we would need to make another adjusting entry when we receive the revenue for that. So yeah, that's a very good example. And as you know, I spent many years in the hotel business myself. I was a financial controller for 15 years, and my last few positions as a financial controller, I was a financial controller for Radisson Hotels in New York State, and then I started working for a smaller hospitality company here in Maryland. So I have a lot of experience when it comes to the hotel world in the accounting department.
Absolutely. That's why I'm looking forward to the conversation after.
Cool. Sounds good. Awesome. Okay. So let's talk a little bit more about the adjusting process. The analysis of updating the accounts at the end of the accounting period before financial statements are prepared is called the adjusting process. So essentially what's happening here is that I am making the adjusting entries into the accounting system at the end of the accounting period before I develop my income statement, balance sheet, statement of cash flows. That's the adjusting process. Adjusting entries are those journal entries that I'm entering into that bring the accounts up to date at the end of the accounting period. So again, for example, I'm taking it from unearned revenue to earned revenue. So how am I doing that? I'm going to debit unearned revenue to decrease the unearned revenue account, and I'm going to credit revenue to represent the increase in my revenue. So that's therefore I'm taking it from unearned to earned. That is an adjusting entry that I would make. Another example would be prepaid insurance. So, like I said before, we always prepay our insurance before we actually consume it, right? This happens to everyone. It's a law. In fact, you have to. So when you prepay your insurance, prepaid insurance is an asset to you and it's a liability to the company. So the way it works for the company is that the company receives the cash, so they debit cash and they credit prepaid insurance, which is a liability account, for that same amount. That's the entry that they make when you prepay them for the insurance. The second entry that they make is an adjusting entry. The adjusting entry that they make is they will debit the prepaid insurance account and credit revenue to take it out of the prepaid and to put it into revenue. That's the adjusting entry that the insurance company makes. So, in effect, all adjusting entries affect at least one income statement account and one balance sheet account. That's why we call it adjusting entries. Are we good so far? Does it make sense?
Yep.
What do you think, Angela? Are we on pace? Are we looking good?
Yes, sir.
Wonderful. Thank you so much.
You're welcome.
Okay. Okay. So let's take a look at the types of accounts that usually require some type of adjusting entry. There's two general accounts that require adjustments: accruals and deferrals. Accruals, as you know, are the bills that we receive from the expenses that have already happened. Or it's recognizing revenue when it happens, right? Through the prepaids, right? So let's dive a little bit deeper. An accrual occurs when revenue has been earned or an expense has been incurred but not yet recorded. So again, it's like getting that bill in the mail. We already know that we consumed the electric, but we haven't received the bill yet. When we receive the bill, that's when we enter it into the system. That's an accrual. The same could be said for revenue. When I make the sale but have not yet received the cash from the customer, I generate an accrual, which is called an accounts receivable. So it's like saying I'm making a sale on account. Okay, when you hear that word on account or that phrase on account, it means that I'm going to impact either accounts receivable or accounts payable, depending on what it is. If I make a sale on account, like I sell this red mug to Dwayne. Okay, Dwayne buys this red mug from me, and I sell to him on account. What does it mean, Dwayne?
Repeat that, sir.
If I sell this red mug to you, and I sell it to you on account, what does that mean?
On account.
Yeah. What do you think it means?
It means that it'd be a credit.
Yeah, exactly.
Yeah, it'd be accredited to you.
Right,
Oh.
exactly. You're absolutely right. Thank you. So when I sell this red mug to Dwayne, the way it works is I sell and ship the mug to him, and then I will get paid later. Dwayne's going to pay me later. So I send the red mug to Dwayne, and then I send a bill, right? And the bill will say, hey, pay me in 30 days. And so he'll then pay the bill to me. But when I send the cup and the bill to him, it creates an account receivable. It means on account. I sold it to him on account. Okay? And so the way it works is that I ship the mug with the bill, and I create an accounts receivable. I increase accounts receivable for Dwayne. Now, when I receive the cash from Dwayne, I reduce accounts receivable and increase cash. Does it make sense?
Yes.
Yes.
Wonderful. Thank you. Okay. Thank you so much. Okay. So the way it works is when I first sell it, I debit accounts receivable to increase my accounts receivable, and I credit my revenue account, which will be sales. I credit my sales account to increase sales. I debit accounts receivable to increase accounts receivable. And I credit sales to increase my sales. So that's the first transaction. And then when Dwayne pays me, I'll make an adjusting entry, or I'll make an entry, right? And the entry will be, I'll debit cash to increase my cash that I received for the sale, right? This is like 30 days later, right? I debit my cash to increase cash, and I credit accounts receivable to decrease my accounts receivable. Think of accounts receivable and accounts payable as what we call contra accounts. They're called contra accounts. What it means is that the accounts receivable and accounts payable, they go up and down. They go up and down in balance, right? It's kind of like an intermediary account. It's the middleman, right? It's the accounts receivable goes up when I send the bill for the sale that I made, and accounts receivable goes down when I receive cash for that sale. And the same could be said when I'm paying bills. So for when I accrue an expense, I will credit my expense. Like, for example, my utility bill, my electric. When I receive my electric bill, I will make a debit to my electric utility expense account, and I will make a credit to my accounts payable. That'll be the first entry I make. So again, I'll debit my utility account or my electric account to increase that expense. And I will credit my accounts payable, which is a liability account, to increase my accounts payable. That's when I receive the bill. Now, I'm going to go and pay that bill. So when I go to pay that bill, I am going to debit accounts payable to reduce the accounts payable, and I'm going to credit cash to reduce my cash. So think of it like, think of adjusting entries as a two-step process. You've made the original entry when you receive the bill, and then you make a second entry to recognize the payment of that bill. Okay. Okay, so let's take a look here. Accrued revenue. The adjustment data, we're now earning the revenue. When we earn revenue, we recognize it at the time it's earned. So going back to Keandre in our example with the wedding venue at the hotel. Okay, so the wedding takes place. At the time the wedding takes place, I generate what's called an accounts receivable. The hotel does, right? The hotel generates what's called an accounts receivable, and we debit the accounts receivable for that particular wedding party. And we're going to credit our revenue account to show that we made the sale and we're increasing our revenue. And then eventually, we'll get paid for that, and I'll show you how that looks. I think it's like the next slide. But this is just the standard entry that we make when we recognize the revenue. Now let's talk about the expense side. Expense. So I received the electric bill. I debit my electric expense to increase my electric expense, and I credit my accounts payable to increase my accounts payable. Meaning I got the bill, I debit the electric expense to increase that expense, and I increase my accounts payable because I have a bill now. I haven't yet paid the bill, So therefore, I'm increasing accounts payable. And then here in a little bit, I'll show you how that, I'll just show you now. So, I'll show you here in a second how that looks. Well, ultimately, the way it works is that after I've made these entries, I will then, when I receive the cash eventually, I'll end up debiting debiting cash and crediting accounts receivable to show that I received that payment. And then the opposite is true for, or the same is true for accounts payable. I would debit accounts payable and credit cash when I eventually pay that bill. So again, just kind of think about accounts payable and accounts receivables as those contraflow accounts. They go up and down based on when you're receiving payment or paying, right? All right, let's talk about deferrals. Deferral means I'm deferring it to the future. Deferring. When you hear the word deferral, it means I'm going to hold off on it, until the future. Here's why. A deferral occurs when cash related to a future revenue or expense has been initially recorded as a liability or an asset. For example, the wedding party makes a deposit on their wedding at the hotel. When I receive that deposit, I call it unearned revenue, and it's a liability for the hotel. The reason why it's a liability for the hotel is because if that wedding doesn't happen, I need to pay that party back, right? So therefore, it's a liability for me. It'll eventually become earned revenue when the wedding takes place. But think of it this way. The wedding party goes to the hotel. They say, hey, we want to have our wedding here. Here's 50% deposit, okay? That 50% deposit, I put it toward their account, but it's unearned revenue for the hotel because the wedding hasn't happened yet. When it happens, then I'll make the adjusting entry. So that's the idea of unearned revenue. It's cash received that's related to a future revenue. It becomes revenue when it's earned. The adjusting entry for the period is when the revenue is earned, debits unearned revenue account and credits the revenue account. That's the entry I make to represent when I earned that revenue. And of course, the same can be said with prepaid expenses. I gave the example of insurance. We prepay our insurance for that next month or that next year or for that next period of time, right? So this is cash that we pay to the insurance company for future expenses. And we record it as an asset to us as prepaid expense. The reason why it's an asset to us is because I can always cancel that account, that prepayment or that insurance, and the insurance company has to pay me back. The adjusting entry for the period is when the expense is incurred, we debit the expense account and credit prepaid expense. So here's how it looks. The first entry we make for revenue, for unearned revenue. The wedding party comes in, they make a 50% deposit. We increase our cash because, hey, we're getting 50%, right? We increase our cash by debiting cash. And we increase our unearned revenue account, which is a liability account. We increase our unearned revenue by crediting unearned revenue. That's the first entry we make. And then, when the wedding actually happens, we are going to debit unearned revenue to reduce our unearned revenue account. Again, unearned revenue is liability account. And we're going to credit our revenue account, which is our sales. That's an equity account. Yeah. And we're going to increase our equity or revenue account by crediting revenue. And of course, with the expense example I gave, our insurance. When I prepay my insurance for next year, I write them the check for the full year, right? I record it as prepaid expense. I debit prepaid expense to increase my prepaid expense, and I credit my cash to reduce my cash on hand. Now, the year goes by, and I've consumed the insurance. So in order to represent the consumption of that insurance, I increase my insurance expense by debiting insurance expense and by crediting prepaid insurance expense to reduce the prepaid expense. Does it make sense? Any questions so far? We're good?
We good.
Okay, sounds good. We're getting there. We're getting through it. Okay, let's look at an example of an unadjusted trial balance. Now, this is our wonderful company, NetSolutions. You all remember NetSolutions from our earlier chapters. It's that same NetSolutions. And don't worry, I'm sure you'll hear about them again in a future chapter. Okay, so here's our company, NetSolutions. What you see here is a list, is our unadjusted trial balance. On an unadjusted trial balance, you'll notice that the first few accounts listed here come from your balance sheet in the order of liquidity. You have cash, accounts receivable, supplies, which is also known as inventory, prepaid insurance, land, office equipment, accounts payable, unearned rent, common stock. Common stock, as you know, is an equity account. Dividends, equity account. Fees earned, equity account. Fees earned is like it's a revenue account. Yeah. So all of these, as you know, are found on your balance sheet. Well, technically, fees earned, it's also on your income statement, right? It's your revenue, which eventually gets adjusted at the end of the accounting period to your balance sheet. We'll talk about that here in a little bit. Fees earned is your revenue, and then you have your expenses, wages, supplies, rent, utilities, and miscellaneous. We list it all out based off of the normal balance that they carry. What is a normal balance? You might be asking. Here's a normal balance. A normal balance means this particular account normally has this type of balance. It's either a debit balance or a credit balance. For example, with cash, my cash account normally holds a debit balance. The reason why it normally holds a debit balance is because it's normally a positive number. I normally have cash in my account that's normally positive, so therefore it normally carries a debit balance. The same can be said for accounts receivable, supplies, prepaid insurance, land, office equipment. These are all asset accounts. Asset accounts normally carry a debit balance. The reason why is because they normally are positive. Okay? Now, other accounts, such as liabilities, they normally carry a credit balance. Liabilities include things like accounts payable, unearned rent, notes payable, anything payable, right? They're liabilities. That's money that the company owes to someone else. Since we owe them, it's typically negative, right? So therefore, it carries a credit balance. The only thing that's a little bit different here are our equity accounts. Dividends normally hold a debit balance because dividends are typically positive. Fees earned, which is your revenue, normally carries a credit balance. Here's why. Because fees earned is a component of equity eventually. We take our if you think about your income statement, you have your revenues minus your expenses equals your net income. Fees earned minus your expenses equals your net income. So that's why fees earned typically carries a credit balance. And your expenses normally carry a debit balance. And the other reason why you see fees earned carries a credit balance and your expenses carry a debit balance is because at the end of the accounting cycle, meaning the end of the year, okay, at the end of the year, we have to close out our revenue and our expenses in order to make sure that they are zero for the next year. Because you cannot carry over balances year to year for revenue and expenses. We call these temporary accounts. Lawan, does that help? Does that make more sense for you? Lawan, are you good? You're on mute, so I'm not able to hear you. Okay, well, hopefully Lawan's good. And if you have more questions about it, just let me know. Now, here are a couple of new accounts, right, that we're now learning about, but are a part of our chart of accounts. As you know, with the chart of accounts, and you learned this from the previous chapters, I think it was in chapter 1, pretty positive chart of accounts. With the chart of accounts, we list out our assets, liabilities, equity, revenue, and expenses in that order. You can see that the chart of accounts is listed out by assets, liabilities, equity, revenue, and expenses. And each account has a number associated with it. The number, and if you look here under assets, it starts with number 1. The cash account is account number 11. Accounts receivable, account number 12. Supplies, also known as inventory, account number 14, so forth and so on, right? 1, 2, 4, 5, 6, 7, 8. The reason why they are in this order and they're numbered this way is because cash, accounts receivable, supplies, prepaid insurance, land, office equipment, accumulated depreciation, all of these things are assets. That's why it starts with a 1, okay? Because it relates to the parent, which is a 1. Think of it like a tree or a diagram. You have assets as your parent account, and then you have all these sub-accounts, right? Cash, accounts receivable, supplies, land, office equipment, accumulated depreciation. That's why they're numbered this way. And the reason why they're in this particular order is because they're in the order of liquidity. Liquidity, as you learned it in the chapter 2, is that liquidity means how quickly I can turn something into cash to use it, right? And the same concept applies for liabilities and equity. And then, of course, on your income statement, you have your revenues and your expenses. And typically, these are just listed out either by alphabetical order or by the balances that they have. Right? Now, you'll notice here a couple of these are highlighted. The reason why they're highlighted is because, well, they're new to you. And we call this the expanded chart of accounts because not all companies have these. These ones that are highlighted are because using the accrual-based accounting system, that's the reason why these accounts exist. If you had a cash-based accounting system, you wouldn't see these highlighted ones. Just wanted to point that out. Okay, let's go through an example of accrued revenue. So our company, NetSolutions, signed an agreement with one of our customers on December 15th to provide services at a rate of $20 per hour. At the end of the year, our company provided 25 hours of service. By the end of that month, we provided 25 hours of service. We're going to send them the bill on January 15th. Now, when I enter the transaction, you'll notice the first thing here is I used December 31 as my date. Why do you think I did that instead of January 15th? Why do you think I have December 31 instead of January 15th? Can anyone answer that question?
To close out the month, but I don't know. No, I don't know.
It's okay.
I think that's the time that you purchased it.
Yeah, exactly. You're absolutely right, Ms. Harris. The reason why we have the date December 31st is because that is when we incurred the sale. That's when we incurred the sale. So that's why we have that date. Because remember, this is accrual-based accounting. So when I accrue something, I use the date for the month of which it incurred. That's usually the last day of that month. So I'm going to debit accounts receivable for $500. Why $500? Well, I provided 25 hours of service at $20 per hour, which equals 500. 25 times 20 is 500. So I debit my accounts receivable, which means I increase my accounts receivable by 500, and I am going to credit my fees earned. That's my revenue account. And I'm going to credit that by 500 to increase my revenue account. Now you're saying, oh, well, Dr. B, how does that impact our accounting equation? So as you know, assets equals liabilities plus equity is the accounting equation. I am going to debit my accounts receivable, which, as you know, is an asset account. So when I increase my accounts receivable, I debit accounts receivable, and that shows right here under your assets. I had a beginning balance. The additional accounts receivable leads me to an ending balance, right? And then since I'm impacting one account, you know I have to impact another, right? So I am going to increase my sales account, which, as you know, is an equity account. Equity is a part of revenue. Revenue and expenses go to equity. So, and this happens at the end of the year. So I at the beginning or before this sale was made in December, my beginning balance was $16,340. I made that additional $500 in sales, which leaves me with an ending balance of $16,840. Does it make sense? Yes, hopefully. Okay. Great. Thank you. Thank you. Thank you. Increase, increase. Yeah. Okay. Now, if the adjustment for the accrued period of 500 was not recorded for whatever reason, either, I forgot it, or I didn't send the bill yet, or I misstated it, or whatever happened, right? If for whatever reason I did not record the accrued revenue of $500, the income statement and the balance sheet prepared would have been misstated. In other words, it would have been $500 short for revenue, and it would have been $500 short for assets, which could cause a problem. So then I would need to make an adjusting entry to get that $500 in. So, yeah, that's that example. Now let's talk about expenses. So our company pays our employees biweekly, like most companies. During the month of December, our company paid $950 in wages on December 13th and $1,200 in wages on December 27th. Remember, biweekly. At the end of the month, December 31, our company owes an additional $250 in wages to employees for Monday and Tuesday, which is December 30 and 31. Because remember, I need to record the expenses in the month in which they occur. So Monday and Tuesday just so happens to be December 30, December 31. On Wednesday, it's January 1st. That's a whole nother year. That's a whole nother accounting period. So what I need to do is I need to make an accrual for the expenses that have occurred in the month of December. So on December 31st, I'll make an adjusting entry. I'll debit my wages expense to represent the 2 days of wages that I incurred for $250. And I'll credit my wages payable. So eventually I need to pay my employees the $250. And this was to accrue wages. On the accounting equation, I am going to credit my wages payable to increase my wages payable by $250. And I'm going to debit my wages expense to increase my wages expense. And as you know, expenses are part of equity. Now, January 10th, the following month, we paid $1,275 on January 10th. The payment includes that $250 that we accrued back in December for those 2 days. So here's how it looks. I debit wages expense $1,025, and I debit my wages payable $250. The reason why I debit my wages payable $250 is because last month I credited wages payable $250 to represent those 2 days that I owed my employees. Now I need to reduce my payable account, so I debit my payable account by that same amount. And I credit my cash, $1,275, to reduce my cash. Does it make sense? Yeah, good. Okay. Now here's how it looks from a visual perspective. As I said, I pay my employees bi-weekly. December 2nd through December 13th, I paid out $950. December 16th through the 27th, I paid out $1,200. December 30th through 31, I paid $250. I cut it off at the end of December 31. Reason being is because the accounting period ends at that month. It ends at the end of every single month. So I made sure that those 2 days did not show up in the expenses for January because the expenses happened in December. So the total amount of wage expense for the month of December was $2,400. Exactly, it has to be balanced on both sides. So the following month, I paid out the $250 plus the wages that were expensed out for those first 2 weeks of January. So for the total month for that first 2 weeks of January, I paid out $1,275. And that's accrued wages. So what would happen if I failed to make that adjusting entry for the $250 for those 2 days worth of wages? Well, my expenses would be understated by the $250, which means my net income would be overstated by that $250. The reason why net income will be overstated is because revenue minus all of your expenses equals net income. If I failed to include that $250 in my expenses, then that means I would overstate my income by $250. I don't want to do that. That's very problematic. So that's why adjusting entries are so important. And of course, on the balance sheet side of things, my liabilities will be understated by $250, and my stockholders' equity would be overstated by $250 because the net income is transferred to the balance sheet at the end of every month as a form of equity. Okay, here's another quick example. December 31st, for our company, NetSolutions, we indicate a balance in the unearned revenue account for $360. The balance represents the receipt of 3 months worth of rent, December, January, February. Okay? So clearly we've been prepaid for rent from whoever's renting our equipment or whatever. At the end of December, we've earned 1 month of rent. So here's how the NRE looks. Again, we were paid for 3 months of rent for our equipment from our customer. Our customer paid us $360 to represent the rental of our equipment from December, January, and February. At the end of December, I need to recognize that I have earned that rental income. So how do I do that? I debit, at the end of December, I debit unearned rent to reduce the unearned rent account by $120, and I credit my rent revenue to increase my revenue by $120. The reason why it's $120 instead of $360 is because I'm earning revenue for only that 1 month. At the end of January and at the end of February, I would repeat the same exact entry. And how does it look on our accounting equation? I am reducing my unearned rent account by $120 and increasing our rent revenue by $120. And if I were to omit that or accidentally forget to make that adjusting entry, it makes it look like my revenue is low by 120, which means my net income will be low or understated by 120. And my liabilities will be overstated by 120, and my stockholders' equity would be under by 120. So these are the impacts of what could happen if I accidentally forget to make these adjusting entries. It slightly skews my income statement and balance sheet. When that happens, and you forget to make those adjusting entries, and you let that go, your investors will not be happy when they find out, oh, I made a mistake here. I forgot to make these adjusting entries. It makes it look like your revenue is lower than what it should have been, and your, it just causes those types of problems. That's why adjusting entries are so important. Okay. This one's okay, I guess. I'm just kind of going a little bit ahead. I just want to. That last one it's not as good of an example. It's very similar to what we're going through. So in this example for prepaid expenses, the same concept applies. So here we go. Our company indicates a balance of supplies account for $2,000. Some of our supplies, this is inventory, right? Some of our inventory was used during the month of December, and some is still left on hand, meaning I can still sell that. So assuming that on December 31st, the supplies on hand is $760, the amount to be transferred from the asset is computed by the following. So at the beginning of December, we said our inventory was $2,000. I used some of my inventory or sold it during the month of December. At the end of December, I was left with $760 of inventory left on hand, meaning I can still sell $760 more at the end of December, which tells me that I sold or used $1,240 worth of inventory. So beginning balance minus ending balance equals what you used or what you sold. Okay, so I utilized some of my own inventory. So at the end of the month, I debit supplies expense to increase my expense by $12,040. I credit my supplies to decrease my inventory by 1,240. And again, to figure out how I got to that 1,240, I took my beginning balance, 2,000, minus my ending balance, 760. And how does it look on the accounting equation? Debit to supplies, 1,240 to decrease that inventory. And I am increasing my expense, 1,240. Prepaid insurance, very similar. Under the year, I used, obviously, some of my insurance. So we had a balance of 2,400 for prepaid insurance. We had a debit balance, 2,400 represents how much I prepaid on December 1 for the next year. For the month of December, of course, I consumed that month of insurance. So to figure out how much I consumed, I take the full amount that I prepaid, the 2,400, divided by 12 months to figure out how much you would consume per month. So since I paid it December 1, and it's for the month of December through the end of November of the following year, that's a full 12 months, right? So I consumed that month of December, therefore I need to make an adjusting entry. I would debit my insurance expense to increase my insurance expense by 200 and credit my prepaid insurance to reduce prepaid insurance by 200. How I got the 200 is I took the 2,400 divided by 12. Assets, I decreased my assets by 200 because it's prepaid insurance, and I increased my insurance expense by 200. The accounting equation is always in balance. And here's how it would look if I misappropriated or if I failed to make that adjusting entry. It would make it look like I'm over by that 200, yeah? Real quick, let's talk about depreciation. Depreciation is an interesting concept. It means that I am depreciating the value of an asset. The best example I could give to you is your car. A car has a specific lifespan, okay, and a specific value. So let's look at this example. Let's say I have a construction business, okay, and in that construction business I have equipment, and that equipment is a dump truck. I purchased the dump truck for $25,000. According to the IRS schedule, my dump truck is expected to has a useful life, meaning how long it should last for, of 5 years. Okay? So what I do is I depreciate the value of the dump truck over that 5-year period. And as you can imagine, you take your $25,000, which is your purchase price, you divide it by the useful life. In this example is 5 years. So that means I depreciate the value of the dump truck $5,000 per year for a total of 5 years until it reaches a value of 0. This is the concept of depreciation. I depreciate fixed assets, plant assets, physical things that the business owns. This would include things like property, plant, and equipment. Except the real difference, the only thing here is that land never depreciates. The physical land, like the earth, the dirt does not depreciate. Okay? The dirt that your house sits on will never depreciate. The reason why the actual dirt doesn't depreciate is because the earth is said to be infinite, which means that the earth itself doesn't depreciate. Okay, the ground will regenerate. The ground can continue to have a useful life, right? That's the idea anyway. So the physical dirt that the building sits on doesn't depreciate, but the building itself does. Okay, so as time passes, a fixed asset like a building, plant, equipment will lose its ability to provide useful services. It decreases in useful life. We call this depreciation. All fixed assets, except for land, which is the dirt, lose usefulness and thus are said to depreciate. A fixed asset depreciates, a portion of its cost should be recorded as an expense. We call this depreciation expense. So at the end of, and I'll show you the entry in a later slide, pardon me. At the end of every single year, with my dump truck example, I increase my depreciation expense by $5,000 by debiting depreciation expense, and I credit accumulated depreciation. We'll talk about that here in a second. The adjusting entry to record depreciation is similar to the adjusting entry for supplies used. We debit the expense account, which is depreciation expense, and I credit accumulated depreciation. This is because the original cost of the fixed asset, in my example, $25,000, and the depreciation is recorded since its purchase is reported on the balance sheet. So we credit accumulated depreciation. Accumulated depreciation is called a contra account, very similar to your accounts payable and accounts receivable. Those are also called contra accounts. This is because accumulated depreciation accounts are deducted from the related fixed asset accounts on the balance sheet. The normal balance of a contra account is the opposite of the account of which it was deducted from. Because the normal balance of a fixed asset account is debited, the normal balance of the accumulated depreciation account is credited. In other words, in order to recognize the fact that depreciation happens on a year-to-year basis, I debit the depreciation expense and I credit the accumulated depreciation until its useful life reaches zero. The dump truck is an asset. The dump truck is worth $25,000. At the end of every single year, I reduce that amount by $5,000. That $5,000 gets allocated to the accumulated depreciation. Accumulated depreciation is technically a liability, okay, which is the opposite of an asset. And I can expense that out through taxes, which is kind of nice. The normal titles for fixed asset accounts and related contra accounts are as follows. Land, there is none. Land never gets depreciated. So if there's a question about land being depreciated, it doesn't. Buildings, equipment, those types of things, those dump trucks, which is equipment, the plant itself, those get depreciated. And they have respective accounts. So building, accumulated depreciation and building expense, store equipment, accumulated depreciation, store equipment expense, office equipment, accumulated depreciation, office equipment expense. Those are the contra accounts. Here's how it looks. So our company has office equipment that we depreciated for $50 during the month of December. We increase our depreciation expense by debiting depreciation expense $50. We credit our accumulated depreciation for office equipment for $50 to increase our accumulated depreciation. Now, as always, you can see here the $50 accumulated depreciation, which is an asset account, goes to depreciation expense, which is recognized as an equity account. Increase, increase. The accounting equation is always in balance. Now, if there's ever a difference between the original cost of the office equipment and the accumulated depreciation, we call that the book value of the asset, also known as net book value. The way we compute it is we take the original cost of the asset, in our case the dump truck, $25,000, minus the accumulated depreciation of that asset. For the first year, it would be $5,000, which would mean at the end of the first year that I have that dump truck on my books, it's worth $20,000. That's the book value of it. And of course, if you decide to omit or accidentally forget to record that adjusting entry, you can understate your expenses, overstate your net income, overstate your assets, and overstate your equity. So those are just things that happen. And then, of course, this is a nice visual representation of accrued revenues, accrued expenses, very similar to what we looked at before. Yeah, class set does end at 7. Is it 7 yet? Almost. Almost. Good question. We're almost there. We're almost at the end.
No, I'm sorry. I
Oh,
was
you
still
have a
in
class
half
at
of it.
7. Oh,
Yeah,
okay. I got you. I apologize. Yeah, this chapter was a little bit longer than I had anticipated because there's a couple of key items. I'm not going to go over this ledger stuff because it's just not as good. Last thing I do want to touch on is called the adjusted trial balance. So after the adjusting entries are posted, we run what's called an adjusted trial balance. And we do this to verify that the total debits and credits are equal on the financial statements. So here's an example of an adjusted trial balance. You have your debits, your credits, all of your accounts listed from your assets to your liabilities to your equity. And then, of course, on your income statement, your revenues and expenses listed out. You can see here by listing out all of the balances for each account, your debits equal your credits. This is the concept of the adjusted trial balance. If for whatever reason one of these does not balance, then we know that we missed an adjusting entry that we have to go back and make. And the reason why we do all of this is in business is to perform what we call a vertical analysis. What this is that we are comparing the performance of our business from year to year. We do that by performing what's called a vertical analysis. We compare each financial statement with the total from the previous year. It's called a vertical analysis. We can do this for the balance sheet, expressed as a percentage of total liabilities and equity. And we can also do this on the income statement as a percentage of total revenue. And all this does is it shows us what the percent change for each line item is from year to year. Like, for example, if my wage expense increased by $15,000 from year 1 to year 2, the reason why that may have happened is because maybe I hired someone. But we do this to basically to see what the changes are from year to year and what we need to do to correct it or to make sure that we are in spec with our previous performance. And you want to do this for your income statement. So that is the end of Chapter 3. Are there any comments, questions, or concerns that I can help you within the next 2 minutes? Or are we good?
I do.
We're good.
We're good? Okay. Wonderful. Well, thank you all so very much. I'm going to go ahead and stop the recording. And if you have any comments, questions, or concerns, please feel free to call me, email me, and schedule office hours with me. As you know, I am available for office hours on Mondays and Wednesdays from 10 to 3. And you can do that by selecting the office hours link. Okay? We're all good?
Thank you. Have a great evening.
Thank